Question 1. Risk assessment procedures indicate that a digital asset firm operating in Alabama has engaged in marketing practices that are demonstrably misleading regarding the risk and potential returns of its offerings. The firm's legal counsel, tasked with advising on compliance with the Alabama Digital Assets Law, is considering several approaches to address this situation. Which approach best balances the firm's legal obligations, ethical responsibilities, and the protection of Alabama consumers? Option A. Advise the firm to continue the misleading marketing but prepare a robust legal defense strategy to counter any potential enforcement actions by the Alabama Securities Commission. Option B. Advise the firm to cease the misleading marketing, deny any wrongdoing if questioned by regulators, and not inform consumers about the past deceptive practices. Option C. Advise the firm to immediately cease all misleading marketing, implement enhanced internal compliance controls, and proactively disclose the past deceptive practices to affected consumers and the Alabama Securities Commission. Option D. Advise the firm to cease the misleading marketing and wait for the Alabama Securities Commission to initiate an inquiry before taking any further action. The correct answer is C. Advise the firm to immediately cease all misleading marketing, implement enhanced internal compliance controls, and proactively disclose the past deceptive practices to affected consumers and the Alabama Securities Commission. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a firm to navigate the complexities of enforcing compliance with the Alabama Digital Assets Law when dealing with a client who has engaged in potentially deceptive practices. The firm must balance its duty to its client with its obligation to uphold regulatory standards and prevent harm to consumers. Failure to act appropriately could result in regulatory sanction, reputational damage, and legal liability for both the firm and its client. Careful judgment is required to determine the most effective and compliant course of action. Correct approach analysis. The best professional practice involves a multi-pronged approach that prioritizes immediate corrective action and transparent communication. This includes advising the client to cease the deceptive marketing immediately, recommending the implementation of robust internal controls to prevent future violations, and strongly urging the client to proactively disclose the past deceptive practices to affected consumers and to the Alabama Securities Commission. This approach is correct because it directly addresses the ongoing harm, seeks to rectify past wrongs, and demonstrates a commitment to compliance, aligning with the enforcement spirit of the Alabama Digital Assets Law, which aims to protect investors from fraud and misrepresentation. Ethical obligations also demand that the firm not be complicit in deceptive practices and take steps to mitigate harm. Incorrect approaches analysis. One incorrect approach involves advising the client to simply stop the deceptive marketing and await potential regulatory inquiry without any proactive disclosure or remediation. This fails to address the harm already caused to consumers and does not demonstrate a commitment to compliance or ethical conduct. It risks further regulatory scrutiny and penalties for the client, and potentially for the firm if seen as aiding in concealment. Another incorrect approach is to advise the client to only cease the deceptive marketing and to deny any wrongdoing if questioned by regulators, while also not informing consumers. This is ethically reprehensible and legally risky. It constitutes active concealment and potentially obstruction of a regulatory investigation, which would be a severe violation of the Alabama Digital Assets Law and professional ethics. A third incorrect approach is to advise the client to continue the deceptive marketing, but to prepare a strong legal defense against any potential enforcement actions. This is fundamentally unethical and illegal. It prioritizes the client's financial interests over consumer protection and regulatory compliance, directly contravening the purpose of the Alabama Digital Assets Law. Such advice would expose both the client and the firm to significant legal and reputational consequences. Professional reasoning. Professionals in this situation should follow a decision-making framework that prioritizes ethical conduct and regulatory compliance. This involves 1. Understanding the specific requirements of the Alabama Digital Assets Law regarding marketing and disclosure. 2. Assessing the nature and extent of the deceptive practices and their potential harm to consumers. 3. Advising the client on immediate corrective actions, including cessation of the deceptive practices. 4. Recommending proactive remediation and disclosure to affected parties and the relevant regulatory body. 5. Documenting all advice and actions taken. 6. Considering withdrawal from representation if the client refuses to comply with legal and ethical obligations. Question 2. Risk assessment procedures indicate that a new digital asset, referred to as Alabama coin, is being offered to residents of Alabama. The offering materials describe Alabama coin as a digital token that can be used to access exclusive content on a proprietary platform, and that purchasers can expect its value to appreciate due to the platform's growing user base and the limited supply of tokens. The issuer is a newly formed company based in Alabama. Considering the Alabama Digital Assets Law and established securities principles, which of the following approaches best guides the determination of whether Alabama coin is a security? Option A. Assume Alabama coin is not a security because it is described as a utility token and is intended for use on a specific platform. Option B. Analyze Alabama coin by applying the Howey test, examining the investment of money, the existence of a common enterprise, the expectation of profits, and the reliance on the managerial or entrepreneurial efforts of others, while also considering the specific disclosures and marketing of the token. Option C. Classify Alabama coin as a commodity because it is a digital asset and therefore falls outside the scope of Alabama securities regulations. Option D. Determine that Alabama coin is not a security because it is traded on a decentralized exchange, implying a lack of centralized control that is characteristic of traditional securities. The correct answer is B. Analyze Alabama coin by applying the Howey test, examining the investment of money, the existence of a common enterprise, the expectation of profits, and the reliance on the managerial or entrepreneurial efforts of others, while also considering the specific disclosures and marketing of the token. Explanation. Scenario analysis. This scenario presents a professional challenge because the definition of a security under Alabama law is broad and can encompass novel digital assets. Determining whether a digital asset constitutes a security requires a nuanced understanding of existing legal tests and careful consideration of the specific characteristics of the asset and its offering. Mischaracterizing a digital asset can lead to significant legal and regulatory consequences, including enforcement actions, fines, and reputational damage. Professionals must exercise diligent judgment to ensure compliance with the Alabama Digital Assets Law and related securities regulations. Correct approach analysis. The best professional practice involves a comprehensive analysis of the digital asset's characteristics against the established legal tests for determining what constitutes a security under Alabama law, particularly referencing the Howey test and its progeny as interpreted by Alabama courts and regulatory bodies. This approach requires examining whether there is an investment of money in a common enterprise with an expectation of profits derived solely from the efforts of others. It also necessitates considering the specific disclosures made to potential investors and the overall marketing and distribution strategy. This rigorous, fact-specific inquiry ensures that the classification of the digital asset aligns with the intent and scope of Alabama's securities laws, protecting investors and maintaining market integrity. Incorrect approach is analysis. One incorrect approach is to automatically classify all digital assets as commodities or currency simply because they are digital in nature. This fails to acknowledge that the form of an asset does not dictate its legal classification. Rather, it is the economic realities and the circumstances surrounding its offering and sale that are determinative. Such a classification would ignore the potential for these assets to be used as investment vehicles, thereby circumventing Alabama's investor protection framework. Another incorrect approach is to rely solely on the labeling or marketing terminology used by the issuer, such as calling the asset a utility token or digital collectible, without independently verifying the substance of the offering. While these labels may be presented to suggest non-security status, they do not override the legal tests if the economic realities point to an investment contract. This approach risks being misled by superficial descriptions and failing to conduct the necessary due diligence. A further incorrect approach is to assume that if an asset is traded on a decentralized exchange, it automatically falls outside the purview of securities regulation. While decentralization can be a factor, it does not inherently exempt an asset from being classified as a security if the underlying economic characteristics meet the definition. The focus remains on the investment scheme, not solely on the trading platform's architecture. Professional reasoning. professionals should adopt a systematic and cautious approach when evaluating digital assets for potential securities implications under Alabama law. This involves 1. Understanding the specific provisions of the Alabama Digital Assets Law and relevant federal securities laws as they apply within Alabama. 2. Applying established legal tests, such as the Howey test, to the specific facts and circumstances of the digital asset and its offering. 3. Conducting thorough due diligence on the issuer, the asset's functionality, the marketing materials, and the expectations being created for purchasers. 4. Consulting with legal counsel specializing in securities law and digital assets when there is any ambiguity. 5. Prioritizing investor protection by erring on the side of caution and treating an asset as a security if there is a reasonable basis to do so, until definitively proven otherwise through legal analysis. Question 3. Risk assessment procedures indicate that a financial firm operating in Alabama is considering offering services related to a novel digital asset. This asset is characterized by its decentralized issuance, its use as a medium of exchange within a specific online ecosystem, and its potential for speculative trading on various digital asset exchanges. The firm needs to determine the appropriate regulatory framework to adhere to within Alabama. Which of the following approaches best ensures compliance with Alabama's regulatory landscape for digital assets? Option A. Conduct a detailed analysis of the digital asset's characteristics against Alabama's definitions of securities and commodities, and assess the firm's proposed activities for any registration or licensing requirements under applicable Alabama state laws. Option B. Assume that because the digital asset is decentralized and not explicitly listed in Alabama statutes, it falls outside the purview of state securities regulations. Option C. Rely solely on the classification of the digital asset by federal regulatory bodies like the SEC or CFTC, assuming their determination automatically applies to Alabama's regulatory requirements. Option D. Conclude that any digital asset not explicitly defined as a security or commodity in Alabama statutes is entirely unregulated, and therefore no specific compliance measures are necessary. The correct answer is A. Conduct a detailed analysis of the digital asset's characteristics against Alabama's definitions of securities and commodities, and assess the firm's proposed activities for any registration or licensing requirements under applicable Alabama state laws. Explanation. This scenario presents a professional challenge because it requires a firm to navigate the complexities of digital asset regulation in Alabama, which, like many jurisdictions, is evolving and can be subject to interpretation. The core difficulty lies in accurately identifying which regulatory bodies and frameworks apply to a specific digital asset activity, particularly when the asset might exhibit characteristics of both a security and a commodity. Misclassification can lead to significant legal, financial, and reputational consequences, including regulatory enforcement actions, fines, and the invalidation of transactions. Careful judgment is required to ensure compliance and protect both the firm and its clients. The best professional approach involves a thorough, fact-specific analysis of the digital asset's characteristics and the nature of the firm's proposed activities in Alabama. This means meticulously examining whether the digital asset meets the definition of a security under Alabama law, considering factors such as investment of money, a common enterprise, and an expectation of profits derived solely from the efforts of others. Simultaneously, it requires assessing whether the asset falls under the purview of commodity regulations in Alabama, which typically focus on fungible goods or services traded on exchanges. The firm must then determine if its activities, such as offering trading, custody, or advisory services, trigger registration or licensing requirements under the relevant Alabama state statutes governing securities, commodities, or digital assets specifically. This approach prioritizes understanding the substance of the digital asset and the firm's engagement within the specific legal landscape of Alabama. An incorrect approach would be to assume that because a digital asset is traded on a decentralized platform, it is automatically outside the scope of Alabama's securities regulations. This ignores the reality that the Howey test and its progeny, which define what constitutes a security, are applied based on the economic realities of an investment, not solely on the technological infrastructure used. Failing to consider the potential for the digital asset to be deemed a security under Alabama law is a significant regulatory failure. Another incorrect approach would be to solely rely on the classification of the digital asset by a federal agency like the SEC or CFTC without independently verifying its status under Alabama's specific digital asset and securities laws. While federal guidance can be informative, state-level regulations may have distinct definitions or additional requirements. Alabama's regulatory framework for digital assets is paramount, and deferring solely to federal interpretations without state-specific due diligence is a critical oversight. A further incorrect approach would be to conclude that any digital asset not explicitly defined as a security or commodity in Alabama statutes is unregulated. This overlooks the broad authority of state regulators to apply existing legal frameworks to new technologies and asset classes based on their functional characteristics. The absence of explicit mention does not equate to a lack of regulatory oversight. Rather, it necessitates a careful application of existing principles. The professional decision-making process for similar situations should involve a multi-step inquiry. First, understand the specific digital asset and the proposed business activities in detail. Second, conduct a comprehensive review of Alabama's statutes and regulations pertaining to securities, commodities, and any specific digital asset legislation. Third, analyze the digital asset's characteristics against the legal definitions of securities and commodities within Alabama. Fourth, assess the firm's activities for any registration or licensing obligations under Alabama law. Fifth, if ambiguity persists, seek legal counsel specializing in Alabama financial regulation and digital assets. This structured approach ensures that all relevant legal and regulatory considerations are addressed, minimizing compliance risks. Question 4. Compliance review shows that a financial advisor in Alabama is considering recommending a new digital asset investment to a client. The advisor has noted the digital asset's recent significant price appreciation. The client has a moderate risk tolerance and has expressed interest in diversifying their portfolio. What is the most appropriate course of action for the advisor to take under the Alabama Digital Assets Law? Option A. Conduct thorough due diligence on the specific digital asset, including its technology, risks, and regulatory status in Alabama. Discuss the investment suitability with the client based on their risk tolerance and financial goals, and ensure all disclosures comply with the Alabama Digital Assets Law. Option B. Recommend the digital asset to the client immediately due to its recent strong performance, assuming it aligns with the client's general interest in diversification. Option C. Proceed with the recommendation without independently verifying the digital asset's compliance with all aspects of the Alabama Digital Assets Law, relying on the issuer's representations. Option D. Advise the client to invest a significant portion of their portfolio in the digital asset, highlighting its potential for high returns, without extensively detailing the associated risks. The correct answer is A. Conduct thorough due diligence on the specific digital asset, including its technology, risks, and regulatory status in Alabama. Discuss the investment suitability with the client based on their risk tolerance and financial goals, and ensure all disclosures comply with the Alabama Digital Assets Law. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a financial advisor to navigate the evolving landscape of digital assets within the specific regulatory framework of Alabama, while also considering the client's unique financial situation and risk tolerance. The advisor must balance the potential benefits of digital asset investments with the inherent risks and the legal requirements for disclosure and suitability, all under the Alabama Digital Assets Law. Careful judgment is required to ensure compliance and protect the client's interests. Correct approach analysis. The best professional practice involves a thorough due diligence process that includes understanding the specific digital asset, its underlying technology, associated risks, and regulatory status in Alabama. This approach necessitates a detailed discussion with the client about their financial goals, risk tolerance, and understanding of digital assets, followed by a suitability assessment that aligns the investment with the client's profile. Crucially, it requires ensuring all disclosures are made in accordance with the Alabama Digital Assets Law, including any specific requirements for digital asset transactions or advisory services. This comprehensive and client-centric approach prioritizes compliance and fiduciary duty. Incorrect approach is analysis. Recommending a digital asset solely based on its recent market performance without a deep understanding of its underlying technology, regulatory standing in Alabama, or the client's specific risk profile is a significant failure. This approach ignores the fundamental principles of suitability and due diligence mandated by ethical standards and likely by the Alabama Digital Assets Law, suggesting a digital asset investment without a clear explanation of the associated risks, volatility, and potential for loss, or without confirming the client's comprehension of these risks, violates the duty to inform and protect the client. This oversight can lead to unsuitable investments and potential client harm, contravening regulatory expectations for transparency. Proceeding with an investment recommendation without verifying that the specific digital asset and the advisory services offered are compliant with all provisions of the Alabama Digital Assets Law, including any registration or disclosure requirements, is a direct violation of legal obligations. This demonstrates a disregard for the regulatory framework governing digital assets in the state. Professional reasoning. Professionals should adopt a structured decision-making process that begins with a comprehensive understanding of the relevant regulatory environment, in this case, the Alabama Digital Assets Law. This is followed by a detailed assessment of the client's financial situation, objectives, and risk tolerance. Any proposed investment, particularly in a novel asset class like digital assets, must then undergo rigorous due diligence to evaluate its suitability, risks, and regulatory compliance. Transparency and clear communication with the client throughout this process are paramount. Question 5. Risk assessment procedures indicate that a financial institution operating in Alabama is considering facilitating transactions involving a newly issued digital asset. Given the specific regulatory framework of the Alabama Digital Assets Law, which approach best ensures compliance and protects investors? Option A. Conduct a comprehensive due diligence process that specifically assesses the risks associated with the digital asset and its underlying technology, implementing tailored controls for Know Your Customer (KIC) and anti-money laundering (AML) procedures, and providing clear risk disclosures to potential investors. Option B. Apply a standard risk assessment framework used for traditional securities, assuming that existing compliance measures are sufficient for digital assets. Option C. Rely solely on the issuer's representations regarding the digital asset's compliance with Alabama law and its inherent security features. Option D. Focus compliance efforts primarily on general anti-money laundering regulations, without specific consideration for the unique aspects of digital assets or the Alabama Digital Assets Law. The correct answer is A. Conduct a comprehensive due diligence process that specifically assesses the risks associated with the digital asset and its underlying technology, implementing tailored controls for Know Your Customer (KIC) and anti-money laundering (AML) procedures, and providing clear risk disclosures to potential investors. Explanation. Scenario analysis. This scenario presents a professional challenge due to the evolving nature of digital assets and the specific regulatory landscape in Alabama. Firms must navigate the Alabama Digital Assets Law, which governs the creation, sale, and management of digital assets, while also adhering to broader principles of investor protection and anti-money laundering. The difficulty lies in interpreting and applying these regulations to new or complex digital asset offerings, ensuring compliance without stifling innovation, and maintaining robust risk management practices. Failure to do so can lead to significant legal, financial, and reputational damage. Correct approach analysis. The best professional practice involves conducting a comprehensive due diligence process that specifically assesses the risks associated with the digital asset and its underlying technology, in alignment with the Alabama Digital Assets Law. This includes evaluating the issuer's legitimacy, the smart contract's security, the asset's intended use, and potential for illicit activity. Furthermore, it requires implementing appropriate controls to mitigate identified risks, such as enhanced Know Your Customer (KIC) and anti-money laundering (AML) procedures tailored to digital asset transactions, and clear disclosure of risks to potential investors. This approach directly addresses the regulatory requirements of the Alabama Digital Assets Law by prioritizing risk identification and mitigation in the context of digital asset transactions, thereby safeguarding investors and maintaining market integrity. Incorrect approaches analysis. Adopting a generic risk assessment framework without specific consideration for the nuances of digital assets and the Alabama Digital Assets Law is professionally unacceptable. This approach fails to account for unique risks such as smart contract vulnerabilities, decentralized governance issues, or the specific definitions and prohibitions outlined in Alabama's digital asset regulations. Implementing a compliance strategy solely focused on traditional financial asset regulations, without adapting to the specific provisions of the Alabama Digital Assets Law, is also professionally unsound. This overlooks the distinct characteristics of digital assets and the tailored regulatory requirements that Alabama has established, potentially leading to noncompliance with specific mandates regarding digital asset offerings or transfers. Relying on the issuer's self-attestation of compliance without independent verification or robust due diligence is a significant ethical and regulatory failure. The Alabama Digital Assets Law places an onus on regulated entities to perform their own assessments and controls, and blindly trusting in issuers' claims bypasses critical risk management steps and investor protection measures. Professional reasoning. Professionals should approach digital asset engagements by first thoroughly understanding the specific regulatory framework governing digital assets in Alabama, particularly the Alabama Digital Assets Law. This involves identifying the precise nature of the digital asset and its intended use, and then mapping these characteristics to the law's definitions, prohibitions, and requirements. A risk-based approach is paramount, necessitating a detailed assessment of potential legal, operational, and financial risks unique to the digital asset. This assessment should inform the development and implementation of tailored compliance procedures, including enhanced due diligence, robust KYC/AML protocols, and clear investor disclosures. Continuous monitoring and adaptation to evolving regulatory guidance and market practices are also essential for maintaining compliance and ethical conduct. Question 6. Implementation of anti-money laundering, AML, and Know Your Customer (KIC) protocols by a digital asset custodian in Alabama requires a robust framework. Considering the Alabama Digital Assets Law, which of the following approaches best ensures compliance and mitigates the risks associated with illicit financial activities? Option A. Conducting comprehensive KYC only at the point of customer onboarding and ceasing all further verification or monitoring activities thereafter. Option B. Relying exclusively on customer self-declarations for identity verification and assuming all transactions are legitimate unless explicitly flagged by external sources. Option C. Implementing a risk-based approach that includes thorough customer due diligence at onboarding, ongoing transaction monitoring, and enhanced scrutiny for high-risk customers. Option D. Applying a uniform, minimal level of KYC verification to all customers, irrespective of their transaction volume or perceived risk. The correct answer is C. Implementing a risk-based approach that includes thorough customer due diligence at onboarding, ongoing transaction monitoring, and enhanced scrutiny for high-risk customers. Explanation. Scenario analysis. This scenario presents a professional challenge for a digital asset custodian operating in Alabama, requiring a delicate balance between facilitating legitimate customer transactions and fulfilling stringent anti-money laundering (AML) and Know Your Customer (KIC) obligations under the Alabama Digital Assets Law. The core difficulty lies in identifying and mitigating the risks associated with anonymous or pseudonymous digital asset transfers, which can be exploited for illicit purposes. A failure to implement robust controls can expose the custodian to significant legal, regulatory, and reputational damage, including substantial fines and loss of operating license. Careful judgment is required to implement procedures that are both effective in preventing financial crime and practical for customer onboarding and ongoing monitoring. Correct approach analysis. The best professional practice involves a multi-layered approach to KYC and AML compliance. This includes conducting thorough due diligence on all new customers, verifying their identities using reliable, independent sources, and assessing their risk profile based on factors such as the nature of their business, expected transaction volumes, and geographic location. For existing customers, ongoing monitoring of transaction activity is crucial to detect any unusual or suspicious patterns that deviate from their established profile. This proactive approach, which aligns with the principles of the Alabama Digital Assets Law and general AML best practices, ensures that the custodian maintains a clear understanding of its customer base and can identify and report suspicious activities to the relevant authorities promptly. Incorrect approaches analysis. One incorrect approach involves relying solely on a customer's self-declared information without independent verification. This fails to meet the fundamental requirements of KYC, as it provides no assurance of the customer's true identity and significantly increases the risk of onboarding individuals involved in illicit activities. The Alabama Digital Assets Law mandates a level of diligence that goes beyond mere self-attestation. Another unacceptable approach is to implement a one-size-fits-all KYC process that applies the same level of scrutiny to all customers, regardless of their risk profile. This is inefficient and ineffective. Low-risk customers may be subjected to unnecessary burdens, while high-risk customers might not receive the appropriate level of enhanced due diligence required to mitigate potential AML risks. This approach fails to adapt to the dynamic nature of digital asset transactions and the varying risks they present. A further flawed strategy is to only conduct KYC at the initial onboarding stage and cease all subsequent verification or monitoring. This overlooks the critical aspect of ongoing customer due diligence. Customer circumstances and transaction patterns can change over time, potentially introducing new risks. Without continuous monitoring, a custodian could fail to detect and report suspicious activities that emerge after the initial onboarding, thereby violating AML regulations. Professional reasoning. Professionals in this field must adopt a risk-based approach to AML/KYC. This involves understanding the specific risks associated with digital assets and the Alabama regulatory environment. The decision-making process should prioritize implementing comprehensive customer identification and verification procedures, followed by continuous monitoring of transactions. When suspicious activity is detected, a clear protocol for internal escalation and reporting to the Alabama Securities Commission or other designated authorities must be in place. This systematic and proactive approach is essential for maintaining compliance and safeguarding the integrity of the digital asset ecosystem. Question 7. To address the challenge of advising a client on the tax implications of their digital asset transactions within Alabama, which approach best ensures regulatory compliance and professional responsibility? Option A. Apply general accounting principles to the digital asset transactions, assuming they are treated similarly to other intangible assets under Alabama law. Option B. Base the tax advice on information gathered from various online forums and discussions among digital asset enthusiasts, as these often reflect current market practices. Option C. Utilize the tax treatment strategies and interpretations that are common in other states with more developed digital asset tax legislation, assuming Alabama follows similar trends. Option D. Thoroughly research and apply any specific guidance issued by the Alabama Department of Revenue concerning digital assets, and integrate relevant federal tax laws and IRS pronouncements that may influence state-level treatment. The correct answer is D. Thoroughly research and apply any specific guidance issued by the Alabama Department of Revenue concerning digital assets, and integrate relevant federal tax laws and IRS pronouncements that may influence state-level treatment. Explanation. Scenario analysis. This scenario presents a professional challenge due to the evolving nature of digital assets and their tax treatment under Alabama law. Professionals must navigate the intersection of state tax regulations, federal guidance, which often influences state interpretation, and the specific characteristics of various digital assets. The lack of explicit, comprehensive state-level legislation specifically addressing all nuances of digital asset taxation in Alabama necessitates a careful, informed approach to ensure compliance and avoid penalties for clients. The professional's duty is to provide accurate advice that aligns with current interpretations and best practices, even when the regulatory landscape is not fully settled. Correct approach analysis. The best professional practice involves a thorough understanding of the Alabama Department of Revenue's current guidance and pronouncements regarding digital assets, supplemented by an analysis of relevant federal tax laws and IRS guidance. This approach prioritizes adherence to the most direct and authoritative interpretations available within the state, while acknowledging the significant influence of federal frameworks on state tax law. By consulting official state publications and federal directives, a professional can construct advice that is grounded in established principles and likely to be accepted by tax authorities. This proactive research ensures that advice is current and defensible. Incorrect approach is analysis. Relying solely on general accounting principles without considering specific Alabama tax pronouncements or federal guidance is insufficient. While general principles are foundational, they do not account for the specific interpretations and directives issued by the Alabama Department of Revenue or the IRS concerning digital assets, which can create unique tax obligations or exemptions. Adopting advice based on outdated or non-specific online forums or discussions, without verification from official sources, poses a significant risk. Such information may be inaccurate, misapplied, or not reflective of Alabama's specific tax laws or the latest federal interpretations that influence state practice. This approach lacks the necessary rigor and authority. Applying tax treatments from other states without confirming their applicability or alignment with Alabama's specific statutory and administrative rules is a critical error. Tax laws are jurisdiction-specific, and what is permissible or required in one state may be entirely different in Alabama. This can lead to incorrect tax filings and potential penalties. Professional reasoning. Professionals should approach digital asset tax implications by first identifying the relevant taxing authority, Alabama Department of Revenue, and seeking out their official guidance, publications, and any specific rulings or directives related to digital assets. Currently, they must research applicable federal tax laws and IRS guidance, as these often form the basis for state-level interpretations. When state guidance is limited, a reasoned application of federal principles, consistent with the spirit of Alabama tax law, becomes necessary. Professionals must maintain a continuous learning process to stay abreast of changes in both federal and state regulations and interpretations concerning digital assets. Question 8. The review process indicates that a financial advisor operating in Alabama is evaluating the potential recommendation of a newly issued digital asset to their clients. The advisor has received marketing materials from the issuer that describe the asset as a utility token with no investment intent. However, the advisor suspects that the economic realities of the offering, including the potential for profit based on the efforts of others, might lead Alabama regulators to classify it as a security. What is the most prudent course of action for the advisor to take under the Alabama Digital Assets Law and related securities regulations? Option A. Proceed with recommending the digital asset to clients based on the issuer's assertion that it is a utility token, assuming it is not a security unless explicitly declared as such by the Alabama Securities Commission. Option B. Recommend the digital asset only to clients who are considered sophisticated investors, believing that such clients are better equipped to assess the risks and regulatory status of digital assets. Option C. Conduct a comprehensive analysis of the digital asset's characteristics and the offering structure to determine if it qualifies as a security under Alabama securities law, and if so, ensure full compliance with registration and disclosure requirements before recommending it to clients. Option D. Rely on the advisor's own subjective interpretation of the digital asset's utility and advise clients to invest at their own risk, without undertaking a formal legal classification. The correct answer is C. Conduct a comprehensive analysis of the digital asset's characteristics and the offering structure to determine if it qualifies as a security under Alabama securities law, and if so, ensure full compliance with registration and disclosure requirements before recommending it to clients. Explanation. The review process indicates a scenario where a financial advisor in Alabama is considering recommending a digital asset that may be classified as a security under Alabama law. This situation is professionally challenging because the regulatory landscape for digital assets is evolving, and misclassifying a digital asset or failing to comply with securities regulations can lead to significant legal and reputational consequences for both the advisor and their clients. Careful judgment is required to navigate the complexities of the Alabama Digital Assets Law and federal securities laws. The best professional approach involves a thorough due diligence process to determine if the digital asset constitutes a security under Alabama's securities laws, specifically referencing the Alabama Securities Act. This includes analyzing the characteristics of the digital asset to ascertain if it meets the criteria of an investment contract, such as the Howey test, or any Alabama-specific interpretations. If the digital asset is determined to be a security, the advisor must then ensure compliance with all applicable registration, disclosure, and anti-fraud provisions of the Alabama Securities Act and any relevant federal securities laws. This proactive and compliant approach safeguards client interests and adheres to regulatory mandates. An incorrect approach would be to proceed with the recommendation without first conducting a rigorous legal and regulatory analysis of the digital assets classification. This failure to ascertain whether the digital asset is a security under Alabama law bypasses critical compliance steps, potentially exposing the advisor and clients to violations of securities regulations. Another incorrect approach involves relying solely on the issuer's representations about the digital asset's regulatory status without independent verification. While issuer statements can be informative, they do not absolve the advisor of their responsibility to conduct their own due diligence and ensure compliance with Alabama's specific legal framework. A further incorrect approach is to assume that because a digital asset is not explicitly listed as a security by a regulatory body, it is exempt from securities laws. The determination of whether an asset is a security is based on its economic realities and how it is offered and sold, not merely its presence on a list. This assumption can lead to overlooking unregistered securities offerings and associated violations. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and client protection. This involves a systematic process of identifying potential securities, conducting thorough due diligence using established legal tests and Alabama-specific guidance, consulting with legal counsel when necessary, and ensuring all recommendations align with the Alabama Securities Act and federal securities laws. A commitment to ongoing education regarding digital assets and their regulatory implications is also crucial. Question 9. Examination of the data shows that a technology startup based in Birmingham, Alabama, is planning an initial coin offering, ICO, to raise capital for developing a new decentralized application. The startup has issued a white paper describing the token, which grants holders access to the platform's features and a share of future network transaction fees. The company's legal team has provided a brief opinion stating the token is a utility token and not a security. What is the most prudent course of action for the startup to ensure compliance with Alabama's securities laws? Option A. Seek a general advisory opinion from the Alabama Securities Commission regarding the classification of all future digital assets before conducting any specific analysis of the current ICO. Option B. Launch the ICO immediately, marketing it as a revolutionary new digital asset, and address any potential regulatory inquiries from the Alabama Securities Commission after the offering is complete. Option C. Conduct a detailed, fact-specific analysis of the token and its offering using the Howey test, as interpreted by Alabama courts and the SEC, to determine if it constitutes a security. If it is deemed a security, proceed with the appropriate registration or exemption filing with the Alabama Securities Commission before launching the ICO. Option D. Rely on the startup's internal legal team's opinion that the token is a utility token and proceed with the ICO, assuming it falls outside the definition of a security due to its technological nature. The correct answer is C. Conduct a detailed, fact-specific analysis of the token and its offering using the Howey test, as interpreted by Alabama courts and the SEC, to determine if it constitutes a security. If it is deemed a security, proceed with the appropriate registration or exemption filing with the Alabama Securities Commission before launching the ICO. Explanation. The scenario presents a common challenge for financial professionals in Alabama, navigating the evolving landscape of digital asset offerings while adhering to existing securities regulations. The core difficulty lies in determining whether an initial coin offering, ICO, or security token offering, STO, constitutes a security under Alabama law, thereby triggering registration and disclosure requirements. Mischaracterization can lead to severe legal and reputational consequences. Careful judgment is required to balance innovation with investor protection and regulatory compliance. The best professional approach involves a thorough, fact-specific analysis of the digital asset and its offering to determine if it meets the definition of a security under Alabama's Securities Act, specifically referencing the Howey test as interpreted by Alabama courts and the Securities and Exchange Commission, SEC. This includes examining the economic realities of the investment, such as whether purchasers expect to profit from the efforts of others. If the analysis concludes that the digital asset is a security, the appropriate action is to comply with all applicable registration requirements or qualify for an exemption, ensuring full disclosure to potential investors. This proactive and compliant stance is mandated by Alabama's securities laws and ethical obligations to protect investors. An incorrect approach would be to assume that because the offering is digital or uses blockchain technology, it automatically falls outside the purview of securities regulations. This overlooks the fundamental principle that the form of an investment does not dictate its substance. If it functions economically as a security, it will be treated as such. Another incorrect approach is to rely solely on the issuer's self-determination that the offering is not a security without independent legal and regulatory assessment. This abdication of due diligence is a significant ethical and legal failing. Finally, proceeding with an offering without confirming its regulatory status, hoping to address compliance later or assuming a lack of enforcement, demonstrates a reckless disregard for the law and investor welfare. Professionals should employ a decision-making framework that prioritizes regulatory compliance and investor protection. This involves 1. Understanding the specific digital asset and its offering mechanics. 2. Conducting a rigorous legal analysis, applying established securities law tests, like the Howey test, within the Alabama regulatory context. 3. Consulting with legal counsel specializing in securities and digital assets. 4. If deemed a security, meticulously following registration or exemption procedures. 5. Maintaining comprehensive documentation of the analysis and compliance efforts. Question 10. Upon reviewing a proposed offering of digital assets by an Alabama-based startup, the issuer intends to raise $4.5 million. The issuer anticipates selling these digital assets to a mix of individuals and entities. To ensure compliance with Alabama's digital assets law, the issuer is considering relying on exemptions from registration. If the issuer can confirm that all purchasers will be accredited investors, as defined by the Alabama Securities Commission, and that no other sales of securities have been made in the preceding 12 months that would aggregate with this offering, what is the most appropriate method to determine exemption eligibility? Option A. Proceed with the offering, assuming that any offering below $5 million is automatically exempt under Alabama law, regardless of purchaser type or prior sales. Option B. Focus solely on Regulation A+ requirements, calculating the offering size against its limits, and disregard the possibility of a Regulation D exemption. Option C. Calculate the total offering amount and verify that all purchasers meet the definition of accredited investors under Alabama law, confirming no prior aggregating offerings. Option D. Assume the offering is exempt because the $4.5 million amount is below the $5 million threshold for certain exemptions, without verifying purchaser status. Correct answer is C. Calculate the total offering amount and verify that all purchasers meet the definition of accredited investors under Alabama law, confirming no prior aggregating offerings. Explanation. This scenario presents a professional challenge because it requires a precise understanding of the Alabama Digital Assets Law's registration exemptions, specifically Regulation D and Regulation A+, and the ability to apply these to a complex financial transaction involving multiple parties and varying investment amounts. Misinterpreting the applicability of these exemptions could lead to significant legal and financial repercussions for the issuer, including penalties, rescission rights for investors, and reputational damage. The core difficulty lies in accurately calculating the aggregate offering amount and determining if it falls within the permissible limits for each exemption, while also considering the nature of the purchasers. The best professional approach involves a meticulous calculation of the total offering amount, considering all potential sales, and then assessing the eligibility of each purchaser under the relevant Alabama Digital Assets Law exemptions. Specifically, for a Regulation D offering, the issuer must ensure that all purchasers are accredited investors if relying on Rule 506, or that the offering does not exceed $5 million in a 12-month period and is made to no more than 35 non-accredited investors if relying on Rule 505. For Regulation A+, the issuer must determine if the offering qualifies as a Tier 1 or Tier 2 offering and adhere to the respective offering limits and disclosure requirements. In this case, the issuer must first calculate the total potential proceeds from the proposed sale of digital assets. If the total offering is $4.5 million and all purchasers are confirmed to be accredited investors, then the offering would likely qualify for an exemption under Regulation D, Rule 506, as it does not exceed the $5 million limit and is made solely to accredited investors. This approach prioritizes accurate financial calculation and strict adherence to the purchaser qualifications stipulated by the chosen exemption. An incorrect approach would be to assume that because the offering is less than $5 million, it automatically qualifies for an exemption without verifying the status of the purchasers. This overlooks the critical requirement of accredited investor status for certain Regulation D safe harbors, or the specific limitations on non-accredited investors. Another incorrect approach would be to solely focus on the regulation, a plus exemption, without considering if the offering size and nature are more appropriately handled under Regulation D, or to miscalculate the aggregate offering amount by excluding certain related offerings or sales within the preceding 12 months, which is a requirement for both exemptions. A further flawed approach would be to rely on a general understanding of federal exemptions without confirming their specific adoption and interpretation under Alabama law, as state regulations can vary. Professionals should adopt a systematic decision-making process that begins with a thorough review of the Alabama Digital Assets Law and its associated regulations. This involves identifying all potential exemptions, understanding their specific requirements, including offering limits, purchaser qualifications, and disclosure obligations, and then applying these to the facts of the transaction. A crucial step is to perform precise financial calculations, ensuring all relevant sales and offerings are accounted for. Documentation of purchaser qualifications and offering details is paramount to demonstrate compliance. When in doubt, seeking legal counsel specializing in Alabama securities law is the most prudent course of action. Question 11. When evaluating the regulatory implications of digital assets for clients in Alabama and considering the precedent set by federal cases such as SEC v. Ripple and SEC v. Telegram, what is the most prudent approach for a financial professional to adopt regarding the classification and offering of these assets? Option A. Assume that federal case law concerning digital assets is not directly applicable to state-level regulation in Alabama, unless explicitly stated by Alabama state regulators. Option B. Conduct a thorough analysis of the facts, legal tests, and reasoning in relevant federal case law, and apply this understanding to the specific digital assets being managed or offered to clients in Alabama to determine potential securities implications under state law. Option C. Wait for Alabama state regulators to issue specific guidance or take enforcement actions related to digital assets before reassessing the firm's compliance procedures. Option D. Rely exclusively on the representations made by the issuers or developers of digital assets regarding their legal status and avoid independent assessment of their classification. The correct answer is B. Conduct a thorough analysis of the facts, legal tests, and reasoning in relevant federal case law, and apply this understanding to the specific digital assets being managed or offered to clients in Alabama to determine potential securities implications under state law. Explanation. When evaluating the implications of landmark digital asset cases like SEC v. Ripple and SEC v. Telegram for financial professionals operating under Alabama's digital asset regulatory framework, a significant challenge arises from the evolving and often ambiguous nature of digital asset classification and regulation. Professionals must navigate a landscape where established securities laws are being applied to novel technologies, creating uncertainty about compliance obligations. This requires a high degree of diligence and a proactive approach to understanding legal precedents and their potential impact on their advisory roles. The best professional practice involves a comprehensive and proactive analysis of relevant case law, specifically considering how the rulings and the underlying legal reasoning might classify digital assets offered or managed by their firm within Alabama. This approach necessitates understanding the specific facts and legal tests applied in cases like SEC v. Ripple and SEC v. Telegram, and then applying that analysis to the firm's own digital asset activities. The justification for this approach lies in the Alabama Digital Assets Law and related state securities laws, which require professionals to act with due diligence and to ensure that their activities comply with all applicable regulations. By thoroughly analyzing case law, professionals can anticipate potential regulatory actions, identify compliance gaps, and provide informed advice to clients, thereby upholding their fiduciary duties and adhering to the spirit and letter of Alabama's regulatory framework. An incorrect approach would be to dismiss the relevance of these cases, assuming they only apply to the specific parties involved or to federal regulations. This failure to consider the precedential value of these rulings ignores the potential for state regulators in Alabama to adopt similar interpretations or to use these cases as persuasive authority when enforcing state securities laws. Such an approach risks noncompliance and exposes both the professional and their firm to regulatory scrutiny and potential penalties. Another professionally unacceptable approach is to rely solely on the issuer's or developer's representations regarding the classification of a digital asset without independent verification. While issuers may assert that a digital asset is not a security, regulatory bodies and courts have demonstrated a willingness to look beyond such assertions to the economic realities of the transaction. Failing to conduct independent due diligence, informed by case law analysis, constitutes a dereliction of professional duty and a violation of the principles of investor protection embedded in Alabama's regulatory framework. Finally, adopting a reactive stance, waiting for explicit guidance from Alabama regulators or enforcement actions before adjusting practices, is also a flawed strategy. The professional standard requires a proactive engagement with the evolving legal landscape. Waiting for enforcement actions is a recipe for non-compliance and reputational damage. The professional decision-making process should involve continuous monitoring of legal developments, including case law, and a commitment to interpreting these developments within the context of Alabama's specific regulatory environment. This includes seeking expert legal counsel when necessary to ensure that advisory services and digital asset activities are conducted in a manner that is both compliant and ethically sound. Question 12. The analysis reveals that an Alabama-based firm is offering a new digital asset investment product to its retail clients. The firm has implemented robust cybersecurity measures to protect the digital assets from external threats. However, the firm is concerned about how to best inform its clients about the inherent risks of this volatile asset class, which approach best aligns with consumer protection principles under Alabama law. Option A. Include a brief, generic disclaimer about investment risks within a lengthy and complex terms of service document. Option B. Provide clear, prominent, and easily understandable disclosures detailing the specific market volatility, potential for significant loss, and the speculative nature of the digital asset, alongside the cybersecurity measures. Option C. Focus primarily on the advanced cybersecurity protocols in place, assuming clients will research the market risks independently. Option D. Assume all retail clients have a sophisticated understanding of digital asset markets and their associated risks. The correct answer is B. Provide clear, prominent, and easily understandable disclosures detailing the specific market volatility, potential for significant loss, and the speculative nature of the digital asset, alongside the cybersecurity measures. Explanation. The analysis reveals a scenario that is professionally challenging due to the evolving nature of digital assets and the inherent risks associated with consumer interactions in this space within Alabama. Ensuring consumer protection requires a proactive and transparent approach, balancing innovation with established legal and ethical obligations. Careful judgment is required to navigate the complexities of digital asset transactions and to uphold the trust of consumers. The best professional practice involves prioritizing clear, comprehensive, and easily understandable disclosures regarding the risks associated with digital assets. This approach directly addresses the core principles of consumer protection under Alabama law, which emphasizes informed consent and the prevention of deceptive practices. By providing detailed information about volatility, security risks, and the potential for loss, a firm empowers consumers to make well-informed decisions, thereby mitigating the likelihood of future disputes and regulatory scrutiny. This aligns with the spirit of consumer protection statutes that aim to prevent consumers from being misled or harmed by financial products or services. An approach that focuses solely on the technical aspects of digital asset security, without adequately disclosing the inherent market risks to consumers, is professionally unacceptable. This failure constitutes a violation of consumer protection principles by omitting crucial information that directly impacts a consumer's investment decision. Such an omission could be construed as deceptive under Alabama law, as it prevents consumers from having a complete understanding of the potential downsides. Another professionally unacceptable approach is to rely on generic disclaimers that are buried in lengthy terms of service agreements, especially when dealing with novel and complex digital assets. While disclaimers are a component of risk management, Their effectiveness is diminished if they are not prominent, easily accessible, and clearly articulated. This lack of clarity and prominence can lead to consumers not fully comprehending the risks, which undermines the principle of informed consent and could be viewed as an attempt to circumvent consumer protection obligations. Finally, an approach that assumes consumers possess a high level of technical expertise regarding digital assets without verifying this understanding is also professionally unsound. While some consumers may be sophisticated, a blanket assumption can lead to inadequate disclosure for a significant portion of the consumer base. Consumer protection laws generally require disclosures to be understandable to the average consumer, not just those with specialized knowledge. Professionals should adopt a decision-making framework that begins with identifying the specific digital assets being offered and the associated risks. This should be followed by a thorough review of relevant Alabama consumer protection laws and regulations pertaining to financial products and services. The next step involves crafting disclosures that are clear, conspicuous, and comprehensive, addressing both technical and market-related risks. Finally, professionals must establish mechanisms to ensure consumers understand these disclosures, such as requiring explicit acknowledgement before proceeding with a transaction. Question 13. Comparative studies suggest that when a consumer in Alabama requests immediate access to digital assets held by a licensed custodian, what is the most prudent and legally compliant course of action to best protect consumer rights? Option A. Indefinitely hold the digital assets due to minor discrepancies in the verification process without providing a clear resolution path. Option B. Initiate standard Know Your Customer (KIC) and anti-money laundering (AML) verification procedures to confirm the consumer's identity and the legitimacy of the transaction before releasing the assets. Option C. Immediately release the digital assets to the consumer to fulfill their request for prompt access, regardless of verification status. Option D. Release the digital assets but refrain from providing any detailed information regarding transaction security, associated risks, or consumer rights. Correct answer is B. Initiate standard Know Your Customer (KIC) and anti-money laundering (AML) verification procedures to confirm the consumer's identity and the legitimacy of the transaction before releasing the assets. Explanation. This scenario is professionally challenging because it requires balancing a consumer's desire for immediate access to digital assets with the legal and regulatory obligations to ensure the transaction is legitimate and compliant with Alabama law. The fiduciary duty owed to the consumer, coupled with the nascent nature of digital asset regulation, necessitates a cautious yet efficient approach. The best professional practice involves verifying the consumer's identity and the legitimacy of the transaction through established Know Your Customer (KIC) and anti-money laundering (AML) procedures, as mandated by general financial regulations that extend to digital asset custodianship under Alabama law. This approach prioritizes consumer protection by preventing illicit activities and ensuring the consumer is legally entitled to the assets. It aligns with the spirit of consumer rights by safeguarding their assets from fraud and ensuring they are dealing with a legitimate entity. The Alabama Digital Assets Law, while evolving, implicitly supports such consumer protections by requiring licensed entities to act in good faith and with due diligence. An approach that immediately releases the digital assets without adequate verification fails to uphold the consumer's right to secure and legitimate ownership. This bypasses essential KYC/AML checks, creating a significant risk of facilitating money laundering or other financial crimes, which is a direct violation of regulatory expectations and ethical standards for financial service providers operating in Alabama. Such an action would expose both the consumer and the service provider to substantial legal and financial repercussions. Another unacceptable approach is to indefinitely delay the release of assets due to minor, easily resolvable discrepancies without clear communication or a defined process for resolution. This infringes upon the consumer's right to access their property in a timely manner and can be seen as a breach of the service provider's duty of care. While due diligence is necessary, an overly protracted and opaque process without a clear path to resolution is not in line with consumer protection principles or efficient service delivery. Finally, an approach that releases the assets but fails to provide the consumer with clear information about the transaction's security, associated risks, and their rights regarding the digital assets is also professionally deficient. While the assets are released, the consumer is left uninformed, potentially exposing them to unforeseen risks and undermining their ability to make informed decisions about their digital assets, which is a core aspect of consumer rights in any financial transaction. Professionals should adopt a decision-making framework that begins with a thorough understanding of the consumer's request and the applicable Alabama digital assets law. This framework should then integrate robust KYC/AML protocols, clear communication channels with the consumer, and a defined, efficient process for transaction verification and asset release. Prioritizing consumer protection, regulatory compliance, and transparency at every step is paramount. Question 14. The investigation demonstrates that a new digital asset, marketed as a revolutionary platform for decentralized finance, has experienced a dramatic price surge followed by a rapid collapse, leading to significant investor losses. Initial inquiries suggest that the promoters made exaggerated claims about the asset's adoption rates and future profitability, potentially constituting misrepresentation under Alabama law. What is the most appropriate course of action for the regulatory body to take in response to these allegations? Option A. Conduct a thorough investigation into the promoter's claims, gathering all relevant documentation, communication records, and financial data to determine if violations of the Alabama digital assets law regarding fraud and misrepresentation have occurred. Option B. Issue a public warning about the volatility of the digital asset and advise investors to exercise caution, without initiating a formal investigation into the promoter's conduct. Option C. Dismiss the allegations as a typical market fluctuation inherent in nascent digital asset markets, advising investors that such risks are to be expected. Option D. Immediately halt all trading of the digital asset and freeze the assets of the promoters based on the initial reports of investor losses, pending further review. The correct answer is A. Conduct a thorough investigation into the promoter's claims, gathering all relevant documentation, communication records, and financial data to determine if violations of the Alabama digital assets law regarding fraud and misrepresentation have occurred. Explanation. The investigation demonstrates a scenario that is professionally challenging due to the inherent opacity of digital asset transactions and the potential for sophisticated fraudulent schemes. Navigating these complexities requires a keen understanding of the Alabama digital assets law and its implications for investor protection. The core challenge lies in distinguishing legitimate market fluctuations and innovative offerings from deliberate deception designed to mislead investors. Careful judgment is required to identify red flags and apply appropriate investigative and remedial actions within the bounds of Alabama law. The best professional approach involves a comprehensive and evidence-based assessment of the alleged fraudulent activities. This entails meticulously gathering all available transaction records, communication logs, and marketing materials associated with the digital asset in question. A thorough review of these documents, in conjunction with an analysis of the digital asset's underlying technology and its stated purpose, is crucial. This approach aligns with the Alabama digital assets law's emphasis on transparency and investor protection, requiring that any claims made about a digital asset be substantiated and not misleading. By focusing on concrete evidence and the specific provisions of Alabama law, this method ensures that any regulatory action is well-founded and directly addresses the alleged fraud. An incorrect approach would be to rely solely on anecdotal evidence or market sentiment, without rigorous verification. This fails to meet the evidentiary standards required for regulatory enforcement and could lead to unfounded accusations or the overlooking of genuine fraud. Such an approach neglects the legal obligation to prove misrepresentation or fraudulent intent, potentially exposing investors to further harm if the fraud is not properly identified and addressed. Another incorrect approach would be to dismiss the allegations outright based on the novelty of the digital asset or the perceived complexity of its technology. This demonstrates a lack of due diligence and a failure to apply the principles of investor protection mandated by Alabama law. The Alabama digital assets law is designed to encompass a wide range of digital assets, and their innovative nature does not exempt them from scrutiny for fraudulent practices. Finally, an incorrect approach would be to take immediate punitive action without a thorough investigation and due process. This not only violates fundamental principles of fairness, but also risks overstepping regulatory authority and potentially harming legitimate market participants. Alabama law requires a structured investigative process to establish facts before imposing sanctions. Professionals should adopt a decision-making framework that prioritizes evidence gathering, legal analysis under the Alabama Digital Assets Law, and a commitment to investor protection. This involves a systematic approach to identifying potential fraud, evaluating the strength of evidence, and understanding the specific legal remedies available. When faced with allegations of fraud in digital asset markets, professionals must remain objective, adhere strictly to the regulatory framework, and ensure that their actions are both legally sound and ethically responsible. Question 15. Analysis of a dispute involving a deceased individual's digital assets in Alabama, where the executor and a beneficiary have conflicting interpretations of the deceased's intent regarding access and distribution, requires careful consideration of available resolution mechanisms. Which of the following approaches best aligns with Alabama's legal framework and professional best practices for resolving such a conflict? Option A. Recommending that the executor immediately file a lawsuit to have a court determine the rightful access and distribution of the digital assets. Option B. Advising the executor to unilaterally grant access to the digital assets based on their interpretation of the deceased's intent, without further consultation or formal process. Option C. Suggesting that both parties wait for a court order to be issued without any proactive steps to resolve the dispute. Option D. Facilitating a formal mediation session between the executor and the beneficiary, guided by a neutral third party, to reach a mutually agreeable resolution concerning the digital assets. The correct answer is D. Facilitating a formal mediation session between the executor and the beneficiary, guided by a neutral third party, to reach a mutually agreeable resolution concerning the digital assets. Explanation. Analysis of the scenario reveals a professional challenge stemming from the inherent tension between a client's desire for a swift and informal resolution and the legal requirements and best practices for dispute resolution under Alabama law concerning digital assets. The need to balance client satisfaction with adherence to statutory frameworks and ethical obligations necessitates careful consideration of available mechanisms. The best professional approach involves initiating a formal mediation process facilitated by a neutral third party, as contemplated by Alabama's digital asset laws and general dispute resolution principles. This method is correct because it provides a structured environment for open communication, allowing parties to explore mutually agreeable solutions while respecting the legal framework governing digital assets. Alabama law, while not mandating mediation for all digital asset disputes, encourages its use as an efficient and cost-effective means of resolution. A neutral mediator can guide the parties toward understanding their rights and obligations concerning digital assets, potentially leading to a binding agreement that is enforceable under state law. This approach prioritizes a legally sound and client-centric resolution. An incorrect approach would be to advise the client to unilaterally attempt to access or transfer the digital assets without engaging in a formal dispute resolution process. This is professionally unacceptable because it disregards the legal complexities surrounding digital asset ownership and transfer, potentially violating Alabama's digital asset statutes and leading to legal repercussions for both the client and the advisor. Such an action could be construed as unauthorized access or interference, undermining the integrity of the dispute resolution process. Another incorrect approach would be to immediately pursue litigation without exploring less adversarial options. While litigation is a recourse, it is often time-consuming and expensive. Alabama law, like many jurisdictions, favors alternative dispute resolution methods where feasible. Resorting to litigation prematurely bypasses opportunities for a more efficient and amicable settlement, potentially increasing costs and damaging client relationships. Finally, advising the client to ignore the dispute and wait for a legal ruling is also professionally unsound. This passive approach fails to address the client's immediate needs and the potential for digital assets to lose value or become inaccessible over time. It also neglects the advisor's duty to act diligently and in the client's best interest, which includes proactively seeking resolution. Professionals should employ a decision-making framework that begins with understanding the client's objectives and the nature of the digital asset dispute. This should be followed by a thorough review of applicable Alabama laws, including those pertaining to digital assets and dispute resolution. The next step involves assessing the suitability of various dispute resolution mechanisms, prioritizing those that are cost-effective, efficient, and legally compliant. Consultation with the client throughout this process is paramount to ensure informed consent and alignment with their goals. Question 16. Consider a scenario where a financial institution in Alabama is offering new digital asset custody services. While the institution has meticulously reviewed and ensured compliance with the Alabama Digital Assets Law, it is uncertain about the extent to which the Consumer Financial Protection Bureau's (CFPB) consumer protection guidelines apply to these novel services, and how to best integrate them into their operational framework. Which of the following approaches best ensures comprehensive consumer protection and regulatory adherence? Option A. Focus solely on the specific requirements outlined in the Alabama Digital Assets Law, believing that state-specific regulations are the only binding authority for digital asset services within Alabama. Option B. Assume that compliance with the Alabama Digital Assets Law is sufficient, as the CFPB jurisdiction primarily pertains to traditional financial products and services, and digital assets fall outside its direct purview. Option C. Implement changes to digital asset services based on the institution's own interpretation of general consumer protection principles, without consulting specific CFPB guidance or seeking external legal advice. Option D. Proactively review and update consumer disclosures, terms of service, and complaint resolution processes to align with CFPB guidance on transparency, fairness, and accessibility for digital asset products, in addition to meeting all Alabama Digital Assets Law requirements. The correct answer is D. Proactively review and update consumer disclosures, terms of service, and complaint resolution processes to align with CFPB guidance on transparency, fairness, and accessibility for digital asset products, in addition to meeting all Alabama Digital Assets Law requirements. Explanation. This scenario presents a professional challenge because it requires a financial institution operating in Alabama to navigate the complex interplay between state-level digital asset regulations and the broader consumer protection mandate of a federal agency like the Consumer Financial Protection Bureau, CFPB. The institution must ensure its practices not only comply with the Alabama Digital Assets Law, but also uphold the spirit and directives of federal consumer protection principles, particularly concerning transparency and fair dealing with consumers. Careful judgment is required to avoid potential conflicts or gaps in compliance. The best professional approach involves proactively engaging with the CFPB guidance and incorporating its principles into the institution's digital asset operations. This means reviewing existing consumer disclosures and complaint handling procedures to ensure they align with CFPB expectations regarding clarity, accessibility, and fairness for consumers engaging with digital assets. By doing so, the institution demonstrates a commitment to robust consumer protection that transcends minimum state requirements and anticipates potential federal scrutiny. This approach is correct because it prioritizes a comprehensive understanding of consumer rights and regulatory expectations, fostering trust and mitigating risks associated with both state and federal oversight. An incorrect approach would be to solely rely on the Alabama Digital Assets Law's specific provisions, without considering the CFPB broader consumer protection framework. This failure to acknowledge the CFPB role could lead to disclosures that are technically compliant with state law, but may be deemed misleading or unfair by federal standards, potentially resulting in enforcement actions or reputational damage. Another incorrect approach is to assume that the CFPB jurisdiction is entirely separate from state digital asset laws, and therefore irrelevant to the institution's operations. This overlooks the reality that federal agencies often interpret and enforce consumer protection laws in a manner that can impact state-regulated entities, especially when consumer harm is identified. Finally, an incorrect approach would be to implement changes to digital asset services based on internal interpretations of CFPB guidance, without seeking clarification or ensuring alignment with the agency's stated objectives. This can lead to misapplication of principles and unintended noncompliance. The professional decision-making process for similar situations should involve a multi-layered compliance strategy. This includes 1. Thoroughly understanding all applicable state laws and regulations, such as the Alabama Digital Assets Law. 2. Researching and staying abreast of relevant federal agency guidance, including pronouncements from the CFPB concerning digital assets and consumer financial products. 3. Conducting a gap analysis between state requirements and federal expectations to identify areas needing enhancement. 4. Implementing robust internal policies and procedures that integrate both state and federal consumer protection standards. 5. Regularly reviewing and updating these policies in response to evolving regulatory landscapes and agency guidance. 6. Seeking legal counsel when navigating complex or ambiguous regulatory areas. Question 17. During the evaluation of a new digital asset offering in Alabama, a financial advisor is tasked with determining whether it qualifies as an investment contract under the Alabama Digital Assets Law. The digital asset is presented as having a functional use within a decentralized network, but the marketing materials heavily emphasize the potential for appreciation in value due to the ongoing development and promotional efforts of the issuing company. The advisor must decide how to proceed with their assessment. Option A. Conclude that the digital asset is not a security because it possesses a functional utility, regardless of the marketing emphasis on potential profit or the issuer's ongoing efforts. Option B. Conduct a comprehensive analysis of the digital assets offering against each element of the Howey test, considering the investment of money, common enterprise, expectation of profits, and reliance on the managerial efforts of others, as interpreted under Alabama securities law. Option C. Rely solely on the issuer's assertion that the digital asset is not a security, as they are the experts on their own product. Option D. Focus exclusively on the technological innovation of the digital asset and its potential to disrupt existing markets, without delving into the specifics of profit expectations or the issuer's role. The correct answer is B. Conduct a comprehensive analysis of the digital assets offering against each element of the Howey test, considering the investment of money, common enterprise, expectation of profits, and reliance on the managerial efforts of others, as interpreted under Alabama securities law. Explanation. This scenario is professionally challenging because it requires a nuanced application of the Howey test to determine if a digital asset constitutes an investment contract under Alabama law, which would then subject it to securities regulations. Mischaracterizing the digital asset could lead to significant legal and financial repercussions for both the issuer and potential investors, including regulatory enforcement actions, fines, and civil liability. The core difficulty lies in distinguishing between a purely functional digital asset and one offered with the expectation of profit derived from the efforts of others. The best professional approach involves a thorough, fact-specific analysis of the digital assets offering and operation against each prong of the Howey test as interpreted under Alabama law. This means meticulously examining whether there is an investment of money in a common enterprise with a reasonable expectation of profits to be derived from the entrepreneurial or managerial efforts of others. This approach is correct because it directly addresses the legal standard established by the Howey test and its subsequent interpretations within the relevant jurisdiction. By systematically evaluating each element, professionals can make a well-reasoned determination that aligns with Alabama's regulatory framework for securities. An incorrect approach would be to solely focus on the technological novelty of the digital asset or its intended use case without considering the investment characteristics. For instance, assuming that because a digital asset has a functional utility, it automatically falls outside the definition of a security, ignores the possibility that such utility might be secondary to an investor's expectation of profit. This failure to consider the expectation of profits and efforts of others prongs of the Howey test is a significant regulatory oversight. Another incorrect approach would be to rely on the issuer's self-serving representations that the digital asset is not a security without independent verification. This demonstrates a lack of due diligence and a susceptibility to misrepresentation, violating the ethical obligation to act with integrity and to protect potential investors. Professionals should employ a structured decision-making process that begins with identifying the relevant legal framework, Alabama digital assets law and federal securities laws as applicable. This is followed by a detailed factual investigation of the digital assets offering, including marketing materials, white papers, operational plans, and the nature of the enterprise. Each element of the Howey test should then be applied to these facts, with a critical assessment of whether the investment characteristics outweigh any functional utility. Documentation of this analysis is crucial for demonstrating compliance and providing a defensible position in case of regulatory scrutiny. Question 18. Research into the Alabama Digital Assets Law reveals that a newly established digital asset custodian, operating solely within Alabama and holding a variety of digital assets, some of which may be considered securities under state law, needs to determine which state regulatory body is primarily responsible for its licensing, registration, and ongoing supervision. Which of the following actions best aligns with the regulatory framework established by Alabama law for such an entity? Option A. Contact the Alabama Department of Revenue to inquire about any tax-related reporting obligations for digital asset custodians. Option B. Assume that general federal regulations for digital asset custodians are sufficient and no specific state agency engagement is necessary. Option C. Submit an inquiry to the Alabama State Legislature regarding the interpretation and enforcement of the Alabama Digital Assets Law. Option D. Proactively identify and engage with the Alabama Securities Commission to understand their licensing and registration requirements for digital asset custodians. The correct answer is D. Proactively identify and engage with the Alabama Securities Commission to understand their licensing and registration requirements for digital asset custodians. Explanation. This scenario presents a professional challenge because it requires a digital asset custodian to navigate the complex regulatory landscape of Alabama, specifically concerning the roles and responsibilities of various state agencies in overseeing digital assets. The custodian must understand which regulatory body has primary oversight for its operations to ensure compliance and avoid potential penalties. Careful judgment is required to correctly identify the appropriate agency for reporting and regulatory inquiries. The correct approach involves proactively identifying and engaging with the Alabama Securities Commission. This agency is vested with the authority to regulate securities and investment activities within the state, and digital assets that function as securities fall under its purview. By consulting the Alabama Digital Assets Law and related guidance, the custodian can confirm that the Securities Commission is the designated body for licensing, registration, and ongoing supervision of entities engaged in activities involving digital assets that meet the definition of a security. This proactive engagement ensures compliance with registration requirements, reporting obligations, and investor protection mandates established by Alabama law. An incorrect approach would be to assume that the Alabama Department of Revenue is the primary regulatory body for digital asset custodians. While the Department of Revenue handles tax matters, including those related to digital assets, it does not possess the regulatory authority for licensing and oversight of custodianship activities themselves. Relying solely on this department would lead to noncompliance with securities regulations and potential enforcement actions. Another incorrect approach would be to contact the Alabama State Legislature. The legislature is responsible for creating laws, not for the day-to-day regulation and enforcement of existing statutes. While the legislature may amend the Alabama Digital Assets Law, it is not the operational body for regulatory oversight of custodians. Finally, an incorrect approach would be to ignore any specific state agency and instead rely on general federal regulations. While federal regulations may apply, the Alabama Digital Assets Law establishes specific state-level requirements and designates state agencies for oversight. Failing to comply with these state-specific mandates would be a significant regulatory failure. Professionals in this situation should employ a decision-making framework that prioritizes understanding the specific statutory framework of the jurisdiction. This involves identifying the relevant legislation, the Alabama Digital Assets Law, researching the designated regulatory agencies within that framework, and proactively seeking clarification from those agencies if there is any ambiguity. A thorough review of the law's definitions and provisions concerning regulated activities and responsible authorities is paramount. Question 19. The risk matrix shows that a new client, Digital Dreams LLC, based in Alabama, wishes to tokenize their extensive portfolio of patents and copyrights. They intend to issue digital tokens representing fractional ownership interests in these intellectual properties, with the expectation that token holders will benefit from future licensing revenue generated by the IP. Considering the Alabama Digital Assets Law, what is the most appropriate initial classification and regulatory consideration for these tokenized intellectual properties? Option A. Classify the tokens as purely digital representations of intangible property exempt from securities regulations as they are not tangible assets. Option B. Classify the tokens as utility tokens, assuming they grant access to certain IP-related services offered by Digital Dreams LLC, without further investigation into revenue sharing. Option C. Classify the tokens as securities, requiring adherence to Alabama securities registration and disclosure requirements, due to the fractional ownership and expectation of profit from licensing revenue. Option D. Classify the tokens based solely on the client's assertion that they represent ownership of IP, without independent analysis of the economic rights conferred. Correct answer is C. Classify the tokens as securities, requiring adherence to Alabama securities registration and disclosure requirements, due to the fractional ownership and expectation of profit from licensing revenue. Explanation: the risk matrix shows a new client, Digital Dreams LLC, seeking to tokenize their intellectual property, IP portfolio, including patents and copyrights, into digital assets on a blockchain. This scenario is professionally challenging because the Alabama Digital Assets Law, while providing a framework for digital assets, requires careful classification to determine the appropriate regulatory treatment. Misclassifying these assets could lead to non-compliance, potential penalties, and reputational damage for both the firm and the client. The core issue is distinguishing between a digital asset that represents ownership or security interest versus one that is merely a digital representation of an underlying tangible or intangible right, without conferring such ownership or interest. The best professional approach involves meticulously analyzing the rights conferred by the tokenized IP. This means determining if the digital asset, as structured and marketed by Digital Dreams LLC, grants the holder a direct ownership stake in the IP, a right to profits derived from the IP, or any other form of security interest. If the token represents a share of ownership, a right to dividends, or is marketed with an expectation of profit derived from the efforts of others, Digital Dreams LLC, it would likely be classified as a security under Alabama law, requiring adherence to securities regulations. This approach is correct because it prioritizes accurate classification based on the substance of the rights granted, aligning with the intent of the Alabama Digital Assets Law to regulate instruments that function as investments. An incorrect approach would be to assume that because the assets are digital and on a blockchain, they automatically fall outside the scope of securities regulations. This fails to recognize that the Alabama Digital Assets Law, like many jurisdictions, looks beyond the technological form to the economic reality of the asset. If the token represents a fractional ownership interest in the IP or a right to future revenue streams, it functions as a security, and treating it otherwise would violate the law. Another incorrect approach is to classify all tokenized IP solely as intangible personal property without further scrutiny. While IP is intangible, the tokenization process can transform it into something that functions as a security. This approach ignores the potential for the digital asset to represent an investment contract, which is a key consideration under securities law. Finally, an incorrect approach would be to rely solely on the client's self-classification of the assets without independent verification. The client's understanding or desire to avoid regulatory scrutiny should not dictate the legal classification. Professionals have an ethical and legal obligation to conduct their own due diligence to ensure compliance with Alabama law. Professionals should adopt a decision-making framework that begins with understanding the client's objectives and the nature of the underlying asset. This is followed by a thorough examination of the rights and obligations associated with the digital asset, considering how it is marketed and what economic realities it represents. This analysis should be grounded in the specific definitions and classifications provided by the Alabama Digital Assets Law and relevant securities regulations. If there is ambiguity, seeking clarification from regulatory bodies or legal counsel specializing in digital assets and securities law is paramount. Question 20. Strategic planning requires a financial advisor in Alabama to assess the potential for digital asset scams. A client, Mr. Henderson, has approached you expressing interest in a new cryptocurrency investment opportunity that promises a guaranteed 20% monthly return, with a referral bonus for bringing in new investors. The opportunity is being promoted through social media channels and involves depositing funds into an offshore digital asset exchange. Mr. Henderson is eager to invest a significant portion of his savings. Considering the Alabama Digital Assets Law, which of the following strategies best addresses this situation to protect Mr. Henderson and comply with regulations? Option A. Immediately advise Mr. Henderson to invest, highlighting the potential for substantial gains and the referral bonus, as the opportunity appears to be a legitimate way to leverage social media for investment growth. Option B. Educate Mr. Henderson on the high probability of such guaranteed return schemes being fraudulent. Explain common digital asset scam tactics like Ponzi schemes and referral fraud, and advise him to conduct thorough due diligence on the exchange and the underlying asset, emphasizing the risks of offshore platforms and the lack of regulatory oversight in Alabama. Option C. Recommend that Mr. Henderson invest a small amount initially to test the waters, assuring him that if the returns are as promised, he can invest more later, and that the offshore nature of the exchange might offer tax advantages. Option D. Inform Mr. Henderson that you cannot provide advice on cryptocurrencies due to their speculative nature and the lack of clear regulatory guidance in Alabama, suggesting he seek advice from a specialist in unregulated markets. The correct answer is B. Educate Mr. Henderson on the high probability of such guaranteed return schemes being fraudulent. Explain common digital asset scam tactics like Ponzi schemes and referral fraud, and advise him to conduct thorough due diligence on the exchange and the underlying asset, emphasizing the risks of offshore platforms and the lack of regulatory oversight in Alabama. Explanation: strategic planning requires a proactive stance against digital asset scams, particularly in Alabama, where the Alabama Digital Assets Law governs these activities. This scenario presents a professional challenge due to the evolving nature of digital asset fraud and the need for financial advisors to not only understand the technical aspects of digital assets, but also the specific legal and ethical obligations under Alabama law. The advisor must balance client interests with regulatory compliance, ensuring that advice provided is both sound and lawful, thereby preventing potential financial harm to clients and avoiding regulatory penalties. The best approach involves a multifaceted strategy that prioritizes client education and risk assessment, directly aligning with the preventative spirit of the Alabama Digital Assets Law. This includes clearly communicating the inherent risks of digital assets, explaining common scam tactics such as phishing, Ponzi schemes, and pump-and-dump schemes, and advising clients on due diligence measures like verifying platform legitimacy and scrutinizing investment promises. Furthermore, it necessitates a thorough understanding of the client's risk tolerance and financial situation before recommending any digital asset investments. This comprehensive educational and risk management framework is crucial for empowering clients to make informed decisions and avoid becoming victims of scams, thereby fulfilling the advisor's fiduciary duty and adhering to the spirit of consumer protection embedded in Alabama's digital asset regulations, an approach that focuses solely on the potential for high returns without adequately disclosing the associated risks or the prevalence of scams in the digital asset space is professionally unacceptable. This failure to provide a balanced perspective and to educate clients on potential pitfalls directly contravenes the principles of informed consent and due diligence expected under Alabama law. Similarly, recommending specific digital assets or platforms without conducting thorough, independent research and without verifying their compliance with relevant securities and digital asset regulations in Alabama would be a significant ethical and legal lapse. This could expose clients to unregistered securities or fraudulent schemes, leading to substantial financial losses and potential regulatory action against the advisor. Finally, an approach that dismisses client concerns about scams or downplays the volatility and risks associated with digital assets, prioritizing transaction volume over client well-being, is a clear violation of ethical standards and regulatory expectations for prudent financial advice. Professionals should adopt a decision-making framework that begins with a thorough understanding of the Alabama Digital Assets Law and its implications for client advisory. This framework should emphasize a client-centric approach, prioritizing education, risk assessment, and transparency. Before offering any advice, professionals must assess their own knowledge and competence regarding digital assets and any relevant scams. If a client expresses interest in digital assets, the advisor should initiate a detailed discussion about the risks, potential for fraud, and the specific regulatory landscape in Alabama. This includes outlining common scam typologies and the protective measures clients can take. The advisor should then conduct rigorous due diligence on any proposed digital asset investment or platform, ensuring it aligns with the client's stated risk tolerance and financial goals, and that it complies with all applicable Alabama laws. Continuous professional development in the rapidly evolving digital asset space is also paramount.